Hey everybody, it's Jason from MAPsignals. Listen, markets are volatile, topsy-turvy, probably great for options traders, but not so great for the long-term investor. But they say the best offense is a great defense. So today, I'm going to show you 5 great defensive ETFs that also have a great dividend for income plays. So let's just get right to it. So let's just jump right in. Looking at the big money index, it's suddenly taking a dive as selling is rocking the market right now, which means correlation is going to 1. That's a fancy way of saying instead of everything, tugging and zigging and zagging opposite to each other, everything's starting to fall. Now, that's on the news of Netflix last week with their disappointing earnings, put a lot of pressure on NASDAQ, thus big tech stocks, and everything is starting to fall in tandem. That is actually good. Usually means we're getting closer and closer to a bottom, but it's still a great time to get defensive. So let's get to our first ETF. So check it out. I'm about to show you 5 defensive ETFs that pay a handsome dividend. Blended together, if you held all 5 of these ETFs in equal weight, you would get an average dividend yield of 5.3%. So let's just dive right in. Now, just as a reminder, how we find all these ETFs is we score and rank over 6,500 stocks every single day on technicals and fundamentals. And then we find the constituents within the ETF and their weightings, and we come up with a score. So what you are seeing right here is a list of all the ETFs that scored within MAPsignals. We have our MAPS score over here, we have our technical score, and we have our fundamental score. And this is how we use our ranking process to find the best ETFs. So here we're starting with our first ETF, MLPA. This is the Global X MLP ETF. Now, if you need to know what an MLP is, it's a Master Limited Partnership. And basically, it gives you all the benefits of being an unlimited partnership investment, getting tax deferments until you get distributions, but the liquidity of an exchange listed product. So this tracks the MLP index, and it is very rich with a bunch of different energy companies. Now, I should tell you that this has a whopper 7.3% dividend yield, and it's filled with terrific companies like solid trending energy companies right now, one of which is Energy Transfer, ET. They own and operate most diverse portfolio of energy assets. I'm reading right from the description here. They have Sunoco in their portfolio, LNG. They have been seeing big money buying recently in this run-up in energy. And if we look at the fundamentals, we got 1 and 3 year sales growth solid, 2-year versus 1 year EPS growth solid. They do make a profit margin, but a lot of money is flowing into energy, and MLPA is paying that handsome 7.3% dividend. Now, next up is a cool one. It is XYLD. Now, this is the Global X S&P 500 Covered Call ETF. What makes this ETF unique and special is it aggregates a portfolio of stocks, some terrific companies, engines of growth for tomorrow, and products we use today, and it writes call options over it. All you need to do, if you're not aware of how this strategy works, is you can think about it as earning dividends on top of dividends. So in the form of long stock, when you write a call against it, perhaps you get called away. You're forced to sell it higher, but you get paid to do that on top of stocks that you earn dividends. And talk about a yield. This thing is paying 10% dividend yield. And you may ask, what kind of companies are inside of it? Well, it's all the big ones, Apple, Microsoft, Amazon, and yes, even Tesla. So imagine being long a portfolio of stocks that include Tesla, Apple, Microsoft, Amazon, and the like, and earning extra dividends on top of it. So this one is really unique. We have not seen a whole lot of big money buying on XYLD, but I like it because it's defensive and it's got a terrific yield. Next up is another energy name. This is VDE. This is the Vanguard Energy ETF. Why do I like this one? We've seen a lot of big money buying in recent months, and now today you see this big sharp gap down. All stocks are under pressure right now as the threat of war heats up in Russia, Ukraine, spilling over to Europe. Potentially, nerves are rattled, fears are high, stocks are slipping. It's a great opportunity to get in because energy should continue to see some tailwinds in this inflationary environment and a potentially protracted war with Ukraine. Now, you see this big money buying. What kind of yield does it pay? It pays 3.2% dividend yield when you hold it. And what type of stocks are you holding? Well, I'm sure you've heard of them. Exxon, Chevron, ConocoPhillips, the big energy producers. Let's look at ExxonMobil. This stock has been on a tear recently. Look at that big money buying, plowing in. This is an old dividend cash cow, and it continues to flourish. We got 1 year sales growth of 57%, 3 year sales growth is 6.2%. Now, the forward outlook for this company is very good considering oil prices are sparking and they make their money on margin. So we can expect this profit margin of 8.2% might continue to grow. So Vanguard Energy ETF paying a dividend yield of 3.2%, also very defensive, being heavy in energy. Again, the best offense is a great defense. So let's look at SCHD, the Schwab US Dividend Equity ETF. Now, it does what it says it does. You're long a portfolio of dividend-paying companies and stable Mabel ones at that for the most part. This thing pays 2.9% dividend yield. And we saw some big money buying back in January. And I expect we're going to see more fresh influx of capital as people get defensive and want to own sort of more stable, large cap dividend paying companies. This is a great portfolio of those. So what kind of stocks does it hold? Well, we got Home Depot, which I personally own, Avgo, and I want to look at this one, Pfizer. I'm sure you've all heard of it over the years, a biotech, biopharmaceutical company. It's been around forever. We've seen a fresh influx of big money buying over the past few months. That red selling looked like it was an opportunity as it gapped higher. Let's look at some of these fundamentals. 1 year sales growth of 95%, 3 year sales growth 24%. We got 3 year EPS growth of 47%. They make a profit margin of 27%. This is a $276.5 billion company. SCHD holds a portfolio of a lot of similar companies, pays a great dividend yield. It's a straight up dividend play for a defensive environment. And the last one is another straight up dividend play, but this is focusing on core high dividends. It's the iShares Core High Dividend ETF, HDV. Look at that big money buying, trending higher straight through this market uncertainty. It's trucking along like a beast. So it's got big money support. It's a portfolio of dividend paying ETFs. Let's look at names like perhaps Johnson & Johnson, Verizon, and ABBV. So let's just take a look over here at Johnson & Johnson. One such company. They make products and services that I guarantee are in your kitchen and rather bathroom cabinets. It's seen strong big money buying because it's a large cap, steady Eddie dividend payer. And let's look at its fundamentals. 1 and 3 year sales growth positive, 2 year versus 1 year positive, 3 years earnings growth 13.3%. Make a profit margin of 22% and do it with little earnings. It's got an 18 PE. It's almost a $500 billion company. You talk about stability. These are the types of stocks you want to own in a defensive environment. Now, HDV, I forgot to tell you, pays a 3.2% dividend. So, in the aggregate, you're getting a portfolio of great dividend-paying stocks. You're earning a yield on owning a diversified portfolio, which limits the volatility as opposed to owning individual stocks themselves. So there you have it, the 5 best defensive ETFs to own for May in a volatile stock market environment with scary headlines and a lot of fearful stuff going on. The best offense is a great defense. I just showed you how. If you like what you see, please like and subscribe down below. It helps us build this channel, bring you more cool stuff. And by the way, please leave comments, suggestions. I know it's rough out there, but hang on, folks, because this is not going to last forever, and you want to be in it to win it in the long run as a long-term investor. If you're looking to shift things to a little more defensive, I just showed you a great way. I will see you next time. Take care.